Thank you for turning in. I want to talk about taxation of Social Security today. It's one of my pet peeves, actually. I really don't like the way this whole thing was done, but let me give you a little bit of background as we're going through the two disclaimers that you'll see. In 1983, the Social Security system was in very bad shape, and so Congress and the president took some action to try to keep it from going insolvent completely. And so the Democrats introduced a bill that would help fund Social Security for a much longer time. Part of that bill was that for the first time in history, part of Social Security would actually be taxed. Now, there is some justification for doing this because we have part of the Social Security that we pay in is deducted from our paycheck, and the other part is matched by the employer. And the part deducted from our paycheck we pay tax on, but the part matched by the employer is a part that has just come free to us in the past, and we've never had to pay tax on that. So in 1983, it was the first time that they came up with an idea to tax that part of the payroll tax that had been paid in, and that's how we accumulate our Social Security is by paying in that payroll tax. So it would have been nice if they had made the computation much easier. If you read the law, and I've got the law here in summary format anyway, but that doesn't describe the whole calculation, and the calculation itself is extremely complex. In 1983, there was not a lot of tax software around for individuals preparing their own tax return to use, and so it must have been a nightmare for people that were filling their forms out on paper, trying to compute this computation. Must have been a nightmare. And that's kind of what irritates me about this whole thing. I mean, in 1986, they started talking about tax simplification, and they passed a law supposedly that would simplify all the taxes. It certainly did not. But this one could have been made much simpler. I mean, they could have just said if your adjusted gross income is over a certain amount, include, say, 40% of your Social Security in your taxable income. But instead, they came up with a very complicated method of calculating how much is included in your gross income, and they didn't adjust it for inflation. So I've got some real problems with it, but it is the law, and so this is what we have to deal with. And thank goodness for good tax software. The impact of not inflation adjusting this law has been dramatic. In 1984, the first year that this law went into effect, less than 10% of the people that were drawing Social Security had to pay tax on that Social Security. When you move up to 2014, more than 70% of people are having to pay tax on their Social Security. And that's been dramatic. I mean, you talk about inflation being a tax. This is a very good example of how inflation has made people pay more taxes. And if you've got any pull at all with ARP or with senators or something like that, you had to be writing your congressman and talking about inflation and getting this thing inflation adjusted, or at least bringing it up to date so not everybody is paying tax on it. Okay, let's take a look at the calculation itself. I'm very grateful today that we have software programs that will figure this out. So if you're doing it by hand, there are software calculators that you can go online and figure out at least the Social Security and what part of your Social Security you owe tax on, which is good. We didn't have that back in 1983. Let's look at an example now. We're going to talk about Ted and Sarah. They have wage income of $50,000 and $30,000 respectively, both 67 years old. They draw a combined total of $34,000 in Social Security. And they have $250 in interest income, $50 in dividend income, and then they have other income of $1,200. So let's use those as a fact, and we'll walk through this calculation. Okay, the first step in the calculation is to add up all your Social Security income. So if your wife's got it, you've got it, add those up. And take 1/2 of it, and then add up all your other elements of income and bring that to a total. So you'll see on this particular slide that 1/2 of their Social Security income is $17,000. They have $80,000 in wages, $250 in interest, $50 in ordinary dividends, and then $1,200 in other income. Now, the other income is actually included on the forms on Schedule 1, and actually this year it's got your business income on there, your farm income, income from S-Corps, income from partnerships. So a lot of different types of income on Schedule 1, and so you're going to have to make sure you pick up all that income. Now, the rationale for only taking 50% of your Social Security income is because you've already paid tax on 50% of that income when it was as part of your gross wages. To that total, you're going to add in some items that may have been excluded for income tax purposes, but the IRS wants them included when you're calculating how much Social Security is going to go into your income. So items like adoption benefits, foreign earned income, I should say, and then certain income from residents of American Samoa or Puerto Rico have to be added back in. Now, most of us that won't happen. I mean, we won't have to add anything in as far as exclusions go, but it could affect some of you out there. After you've added back any exclusion income, the next step is to go to Schedule 1, Part 2, and look at any adjustments that may have been deducted for income tax purposes that cannot be deducted in calculating your taxable portion of Social Security. So these things have to be added back into your total income so that you can complete the calculation and go on with it. You'll note on the previous slide that Ted and Sarah had to add back in an adjustment of $200 for educational expenses. Educators are allowed to write off as a deduction $200 in their books and fees and whatever they have for the class, but not for Social Security purposes. So here they have to add it back in so they can compute how much is going to be, what part of their Social Security is going to be taxable for income tax purposes. Just to note that the terms in bold are my terms. I've just added these terms to make it a little easier for you to follow the example. So the IRS does not use these terms. They use line numbers instead, which is a little bit more difficult to follow. In the example that we're carrying through, Ted and Sarah have $98,700 worth of total income. And they're going to subtract the $32,000, which is the base amount for a married taxpayer filing jointly. And they come up with $66,500, and I'm calling that base income. Let me make a point here that the $32,000 and the $25,000 are the numbers that should have been inflation adjusted. Those numbers have not changed since 1983, and that's what's led 10% of the tax back in 1984, 10% of the population drawing Social Security paying tax on Social Security, raising up to over 70% of individuals drawing Social Security paying tax on it today. If you look at the next slide, the numbers there, the $12,000 and the $9,000, approximate 1/2 of the 2018 standard deductions. One difference is that the single standard deduction, 1/2 of that would be $6,000 instead of $9,000, but they're using $12,000 and $9,000. This is even used on the 2019 form. Very interesting to note that in 2019 the standard deductions were inflation adjusted, but these numbers are not inflation adjusted, and I don't know if that's a mistake in the form or if that's the intent of the IRS. But either case, you actually will subtract these numbers from the number that you had your base income to come up with your net base income. So we have net base income of $66,500 for Ted and Sarah. Then they subtract out the $12,000, as we saw in the previous slide, come up with $54,500. Then the calculation gets kind of interesting because they start comparing that $54,500 to other numbers. And in the end, they come up with $34,000, the total amount of Social Security that the couple received for the year, being multiplied by 85%, and then that included in taxable income. Now, what that says to me is that they're double taxing 35% of your Social Security. I mean, you paid in 50% of it, and now they're taxing 85%, which means the difference between 50 and 85 is 35, so they're taxing 35% of your total Social Security. Now, they may justify that by saying, well, there's been interest all these years or something, and but still, I'm of the mind that nobody should be taxed on Social Security more than 50% of their Social Security should be taxed. In conclusion, you can see that the calculation is a difficult one. Lucky we have tax software these days. But 70% of taxpayers today, over 70%, who are drawing Social Security are paying tax on it. And that's up from less than 10% in 1983. If you are making over $70,800 or $71,000 in there, you're paying tax on 85% of your Social Security. And I just think that's wrong. If in this example, Ted and Sarah, for example, are going to pay over $6,000 in additional tax because they're taxed on their Social Security, 35% of which is could theoretically be thought of as money that they've already paid into the system. Now, you might argue that there is interest in stuff, but hey, I didn't give anybody permission to give the federal government a low-interest loan on my money. I think I could have done better on it. If you have further questions about Social Security and the IRS, read publication 915. It talks all about it. And if you don't want to go through this calculation, like I mentioned earlier, use a prepaid tax preparer, paid tax preparer, use a calculator online, or get your own tax software and do your tax return in your own tax software, which I think is what a lot of people are doing today. Good living, until next time. It's been good to be with you. Thank you very much.